Welcome back to the channel. This is Neil Campbell with Living Ecosystem Design. Tonight, I'm going to talk about my summary of the last or most recent article I did on my LinkedIn page called "It's Time to Rethink the Tenant Landlord Model, a Living Ecosystem Design Housing Framework." Now, if this is your first time visiting this channel is about how to create the best ideas and solutions on the way we live, which is to take the best concepts of our current infrastructure and polishing them to bring them together to improve and enhance our way of life. Most of the things that I talk about is not new, but it's a different perspective in looking at it to make it a solution to solve a big problem. Now, the article before this one, I gave a gift for people who own properties. But for this article that I'm going to review tonight, and I'm going to drop the link to the article on LinkedIn so you can read through the framework, I want to give a perspective on people who rent. Now, for those who are property owners, whether you're aware of this or not, when you have a property, you literally have 4 to 5 rents that you pay. 4 to 5 rents. And the first rent is, if you're not able to buy the house outright, is the mortgage. That's the rent you pay to the bank. The permanent rent that you have is taxes. That never goes away. Whether you have a mortgage or you pay it off free and clear, you always have to pay at the end of the year. The next rent you pay is insurance. You need to have that, especially if you have a mortgage on the house. If the house is paid for, you can choose not to, but you make yourself vulnerable to catastrophic event and not have enough resources to pay for damage such as fire or total cost to actually rebuild the structure, or total loss, or replace the total loss of the structure. The fourth one is repairs and upkeep. That does not go away neither. Something gonna break, whether it's the plumbing system, water system, HVAC system, electrical system, the roofing, something's going to go wrong. And when it does go wrong, usually you're really caught off guard with a huge bill in the thousands. And the fifth bill, if you have a house in a subdivision, it's called your homeowners association dues. You don't pay that, they can put a lien against your house and put you out your house. 5 rents. 5 rents. Now, here's where people can now say, well, I don't have a house. I rent an apartment. Well, renting can be beneficial if it's structured in a way where you as the renter is looked upon as a community member contributor, where you have a stake in every time you pay your rent every month, you have a stake in the actual development that you live in. Now, here's what I mean by that. The current model for renting is usually an adversarial relationship between the tenant and the landlord. The tenant just sees the landlord as a collector. The landlord just sees the tenant as someone that can pay the rent, or if you can't pay the rent, evict, replace with another person that can pay the rent. The tenant usually have no stake or care for the grounds or making sure that they take care of the place that they're actually renting, because they feel like they have no ownership or ties to it. It's pretty much the landlord's property. But the proposal that I outlined in this article that I'm reviewing, it allows a new framework by saying, what if we gave tenants an opportunity to become investors, real community members, where every month you pay your rent, a fraction of the rent goes into an investment account where that money can recirculate to invest in other new developments in the portfolio of the company that actually owns and controls the place that you rent from. So for example, if you pay, let's say on the high side or fairly high side nowadays, if you want to call it $2,000 per month for easy math, and the development management company was kind enough to give you 10%, right, towards your portfolio account, that'll be $200 every month. If you were to get 10 to 12% return on that investment over, let's say, a 20, 30-year period, that can amount to be a significant amount where one day you can retire from paying rent. Just like how the previous article I talked about the property savings account, which will enable property owners to retire from paying for those 5 rents or 4 to 5 rents that I mentioned, especially the property tax rent that never goes away. Okay? So these are the things that I like to work on. How do I come up with ideas? By looking at our existing ecosystem when it comes to, let's say, multifamily, and say what can be tweaked and revised. Now, this is not something that should be mandatory, but smart property management companies or development companies that own their portfolio, if they want to remain competitive and have tenants that commit for the long term, they will incorporate these incentives to make sure that they lower the turnover rate. They can have people stay in their apartments for 20, 30 or more years, even 40 years. Because when people have a stake, they're not going to leave. And so the thing is, you'll even see videos on YouTube circulating saying that it's more beneficial to rent than to own a single family house. It all depends on how you look at the perspective, right? Now I can talk about the house side, but I want to focus on the apartment side. So with apartment now, if you rent from a community that is a true community, not these places that just call themselves a community, but it's just a place to collect your rent, but they give you benefit and support and give you a portion of the upside. As the development and the portfolio becomes more wealthier, you have a stake in it as well. That is the future. And the portfolio companies that understand these dynamics, they will have more loyal people that's paying into the sustainability of their developments, right? Where, for example, in this model, the 10% that I just mentioned from the 2000, which is, let's say, $200 per month, right? I'm going to go to this thing real quick. I like to go to my investment calculator. It gives perspective. And I always tell people who come and view this channel, we don't have a lot of people who are following yet, but as we grow over time, we will have smart people who understand the strategies that I outline on this channel here. And by the way, if you're getting some value from the content that I put out, please like, comment, share, and subscribe. And hit the notification button so you will be aware whenever I put out the next video. I try my best. I'll have a very busy schedule. This week was very, very busy, but I had to make sure I put some time in to create a summary of this article that I posted a few days ago. And my next article is dropping Sunday. So therefore, check out my actual content on LinkedIn and subscribe on that page as well. So let's say we start off in this program. So someone they're renting an apartment, and this is their first month. So they paid it $2,000 a month for whether it's 1 bedroom or 2 bedroom, whatever you can get for those kind of prices now, right? So now in that amount now, the portfolio manager sets aside $200 to start off the account. They're hoping for the tenant to stay put within their ecosystem, because one of the things that I've outlined too as well, even in some other work I've been doing over the years, and some I have not shared yet, is having long-term people in your development that can move around. If you look at it today, some people can say they're renting from one development, then they move to another one and another one. But if you have people moving within the ecosystem, then you can capture the revenue from those members without losing them to other people coming in, right? So that's another thing too, developers or portfolio managers can actually incorporate into their business practice. So we're going to say 30 years we're looking for, just like how someone would rent. So if we were to compare someone who's paying a 30-year mortgage to pay it down, so they can say they own it free and clear, but this person's opting for renting. And we're going to assume that, let's say they don't have any other type of retirement benefit. Things were bad. The labor market was not as consistent. They start a job 2 years, 3 years, something happened. They cash out the 401k and they've just been having a hard time. But they've been able to maintain that $2,000 a month rent. And we're gonna assume it's consistent across the line, right? Could be plus or minus. So $2,000 a month for 30 years. And we're gonna say 12% return, which is somewhat modest for real estate. There's some REITs that's given even more than that, but that's kind of around average, right? So we're gonna say 12% over 30 years, and we're gonna hit the calculator button. And what do we have? In 30 years, this account will be worth $616,394.64. I repeat, $616,394.64. Let's look and see, after 30 years of paying rent, or when exactly could this person retire from paying rent, where monies from this account can more than pay the $2,000. Let's go down the timeline and see when they would retire. At around, let's see here, right, I want to say around the third month, the second month in the 21st year, this account would be able to pay the $2,000 rent. And if they were to leave it alone until the full 30 years has expired, that account would pay $5,791.98. Excuse me, $5,791.98 per month, which means they would have literally $3,791.98 left over after paying the $2,000 rent. This is something that can change lives. Instead of people renting for all those years and end up leaving with nothing, we have a true community that allow them to buy in. Also, if there were, and also what I'm proposing in this actual framework, they can add additional monies to that account to make it grow even more. So let's say they get the $200 per month towards this investment account within the portfolio of the company that owns the property, right? And they say, you know what? They're gonna match it. So since the 2,000, 10% of the 2,000 brings 200, they say, okay, let's make it $400. So 2 out of their pocket and 200 comes off the top from the rent. And let's see where we are right now. In 30 years, the account, assuming all goes well and is managed well by the portfolio company, because mind you, the money is going to come together with all those other people who were once traditional tenants to now become community investors. So you see your tenant as community investors. So instead of trying to raise money from outside source, you raise money from the community members' accounts. And that money now can be used to acquire land, buy out properties, do all these things to make further cash flow. Now, here's a number. After contributing $200 more to the 10%, which is the 200 that the rent provides, a total of 4 every month, over 30 years at 12% interest per year, would be $1,226,797.30. One more time, $1,226,797.30. How much would that bring in every year? This is where your housing takes care of your living expense. No more will we say you're depending on Social Security or your job pension plan or retirement plan to take care of your years when you're no longer able or feeling like going to work. You can say, you know what? I can have multiple streams of income. For some members, they can say, you know what? I have my retirement benefit from my job after retiring. I have Social Security. Now I have my portfolio with my housing community that I'm a part of that pays me resource as well. So people can have 3, 4, or even more streams of income. So now if we look at it, at 30 years, this $1.2 million account would generate $131,159.17 per year. Let that soak in. Per year. How would you feel if you had an account that was linked to your housing, that had that amount of money that you can take and go anywhere in the world with, or stay within the ecosystem? If you decide to, let's say, downsize, if someone who have a single family, they have to go get a broker to go advertise, sell, have people come look at the place, blah, blah, blah. But when you're living in a real community ecosystem, you can downsize within the ecosystem. You may downsize down the hallway from a 2-bedroom to a 1-bedroom, or from a 1-bedroom to a studio. Depends on whatever your needs are. You could even say, you know what? The portfolio has properties in Thailand or properties in Jamaica. And then you can say, you know what? I want the equivalent or pay a little extra to move into another place that is in the actual portfolio. Because the more people support and invest in the actual community ecosystem, the more resource they have to invest in areas that the members are interested in living. So if the people have an interest in an area, they don't have to speculate and say, well, I wonder if we build this development for $200 million, people will come. You don't need to worry about no more, because you have people that's within your ecosystem that has the resources, and they're committed people to make sure that those developments become a success. So this is going to help from all angles. The people who control the portfolio, who are now looked at as the landlord, they will be able to can have resources to help fund new developments or buy out projects that they want to add to their cash flow. So if you look at it now, $131,000. I don't know if you're excited, but I'm excited because millions of people could benefit from this. We look and see how people are losing traditional jobs. What if you were living in your apartment development or your development, your community development for 20, 30 years, and you can literally draw from this. You can draw from this account, and it's not necessarily linked to the stock market. Nothing wrong with the stock market, because in my property savings account model, we talk about how monies can be invested in the index market or index funds, right? Which are baskets of companies where you can literally have more security with your funds, instead of saying you invest your money this year and next year the company you invest in went bankrupt. And you're like, where's my money? I'm sorry. Didn't you read the fine print? It was risky. So you lost everything, at to start from square one. So now, when we look at this now, at $131,000 per year, what would that be every month? Now, you know, it's a lot of months. Let's scroll on down to the bottom. A lot of months. $11,527.65. Now, even if the rent was to double to $4,000 per month, you still have plenty money left over to reinvest and have it compound and compound and compound and compound. You can even take a loan against the value of this portfolio without having to sell anything and create a taxable event. Smart portfolio companies who really want to maintain longevity and consistency and low turnover rate should look into this model and contact me for more details on how this works. But I just want to summarize the article, and I will leave the link so you can take a look at the framework to kind of look at the ideas that's in this framework that I'm providing to help shape and impact the lives of millions of people, especially in the Atlanta region where folks are feeling frustrated. They feel stuck. They've done everything they could do and they feel left out. I'm here to say today, this is to celebrate people who rent. But instead of you renting, you're now you're a community investor where you have a stake in the development that you live in. And after you rent for a certain amount of years, you can look into an account and that has value in there. We can draw from it. You don't need to ask for handouts. You don't need any type of nothing. You can just go and take from that account and take care of your needs. That's what we're doing here at Living Ecosystem Design. We're creating strategies in existing infrastructure and different ecosystems to make sure we can get the best out of life, to have the best human experience we can in our life right now. Not just one day, but right now. But you build slowly over time. Without even looking at it, you're accumulating wealth. And then this wealth can be transferred over to your children and your grandchildren and so forth, for those who happen to want to have a family in that kind of traditional way. But anyway, that's the summary. Go on my LinkedIn page, Living Ecosystem Design, and check out the article where I outlined the framework. There's not a lot of mechanical details. I'll leave that for more of my intellectual property, for people to kind of reach out to me for those kind of details. But check it out. Like or follow the channel and look for all the articles that I drop every Sunday. And again, if you see some value in this channel that I'm creating, I'm trying to get into the whole habit of being consistent and sharing quality strategies to help people figure out their situations. And there's nothing wrong with where you are. You just need a strategy to get yourself out of where you are. And every Sunday, the articles that I publish on LinkedIn talks about those strategies. And what I try to do when I do these videos is to kind of create a human effect where I summarize it and bring it more into a context of how this can relate to your situation, right? And I try to make sure I put the effort in to put the videos out, even if I feel tired. I come from work and I say, you know what, let me do these videos so I can even help one person. If I only help one person, then I've done my job. So again, like, comment, subscribe, and share with your friends and have a discussion. And let's build this community together as we grow over the next couple of years to make something long-lasting and effective for those who need a solution. Until then, I see you in the next one. Take care.